Good morning, everyone. Welcome to Fundamentals with Matt Burk. I am your host, Matt Burk. This is an educational series designed to try to help you understand everything you need to know about how and when and why to run or to not run and launch a real estate pooled investment fund. And my guest today is Sief Khafagi, who is a founder at TechVestor. And I met Sief, maybe 3 or 4 weeks ago when we were both in Salt Lake City for the Best Ever Conference 2023. And I'll give you a little more about that here in a moment. But welcome, Sief, to the show.
Thanks, Matt, for having me. Yeah, it was a pleasure. Snowy days in Salt Lake, very different than here in sunny Los Angeles.
Yeah, although LA hasn't been as sunny as normal, from what I understand.
Hasn't not at all. It's getting better though. It's getting better.
Yeah, well, that's good. That's good. Well, California's got plenty of water now, so that's a positive.
Very true. Very true. We're apparently beating Seattle in that metric this year.
Yeah. So the Best Ever Conference, Verivest hosted and sponsored a pitch fest or a pitch slam, and we had 75, 80 applicants to apply to come in and present. And the winner of the contest, so there was the first and a second place, and it was awarded a investment from a group of judges, one of which was me and 5 other qualified and high caliber judges. And we ran that contest, and Sief was in the finals and came in second. So he got Sief TechVestor got a $200,000 commitment to their fund. So that's kind of how we met, and kind of got to know a little bit about what you guys are doing. But for the benefit of the listeners, why don't you tell us a little bit about TechVestor, what you guys do, what your strategy is, and give us kind of a high-level overview of your company.
Yeah, so TechVestor tackles the short-term rental industry. We're one of the first institutional grade options to invest in short-term rentals, or Airbnbs as many people know it, as an asset class. And we built some really great proprietary technology that allows us to combine both technology and talent. We have an incredibly talented team to make the investment experience as passive as can be. So if you're familiar with syndication, or if you invested in multifamily or other asset classes, you simply write a check and we do the rest, right? So we find, design, furnish, run, operate the property. We send you a check every single quarter, and your investment is diversified across hundreds of properties, geographies, locations, seasons, and we're really one of the first to scale short-term rentals to that level.
So you're doing it in a pooled format. So how did you guys get into, what made you decide that particular asset class, and kind of how did you get into that in the first place?
Yeah, so when I was at Facebook, I spent about 5 years there, predominantly building teams and infrastructure. And when you opened up an office, and I'm sure you know about this, Matt, building some successful companies in your past, you're not only attracting people to your company, but you're attracting them to a location. This is pre-pandemic, right, for many years. And you needed to understand where they were going to sleep, where they were going to play, where their kids are going to go to school, where they're going to go, have dinner on a Saturday night, because they need to have these attractions. And we stayed in a bunch of Airbnbs as we were opening up offices, and we realized that the experience was really poor, and that the problem with the industry was typically the host, which lacked the experience and the time and the energy and the know-how, and typically the property manager, who was only concerned about driving top-line revenue. So it didn't make it investable. So we built technology to allow us to identify the best possible properties to buy, to operate at the highest level, and really tackle a vertically integrated problem with technology and people, right? So we built boots on the ground in all of our markets, where we can actually go tackle, $200,000 renovations, really great hospitality, all those types of things, giving us a competitive edge in the market. And really, after staying in a bunch of really poorly ran and operated Airbnbs, and while there were some good ones, we realized that 95% of the time we were, staying in someone's house who didn't really view this as a business, but viewed it more as a hobby. And that was really where the opportunity was built.
Yeah, so you've identified a real world problem. You come from a tech background, right? So not necessarily a real estate background per se. Is that correct?
Yeah, I mean, we've had our own investments in our own properties, but nothing to this level of scale, and definitely came at it with a tech lens more than anything else to begin with. But our team comes from an industry perspective of real estate a lot more than Sabrina and I.
Yeah. So, okay. So you guys come at it from kind of a tech perspective, solve a real world problem. And then when you decided to do this, how did you go about acquiring kind of your first asset? Did you put your own money up? Did you syndicate an individual deal, or what was your capitalization structure and strategy for the
Yeah.
business?
Before we actually started as a syndication, we thought our business model would be, help people buy their own property. So single LLC, single member, or two members, where we did all the work and someone else put up all the money, right? In a single kind of like a joint venture. And we did that about 7 or 8 times. And we got all our early customers and clients and investors on a call together as we were kind of gathering feedback early. And we saw the same thing happen time and time again. Every individual was enamored with someone else's property. They said, "Hey, Matt, your property looks great. I wish I had a piece of that." Right. And they were explaining, they didn't know it, a pooled fund or a pooled investment vehicle where they all had a share in this portfolio of all these assets, pro rata based on their investment. And when we brought up that idea, it was an overwhelming yes. So we pivoted, moved over all those assets and converted that over to our fund structure, our pooled investment vehicle. And then within the next 30 days, we raised another $7 million from investors because apparently that's what everyone else was looking for too. So that was kind of our aha moment, product market fit. We were doing the right things. We were just doing it in the wrong vehicle at the time. And therefore, when we pivoted, we really saw that traction pick up pace.
So one of the things that I try to focus on the show, Sief, is like helping managers who are trying to set up pooled investment vehicles understand what that's like, what it's about, why they might do it, why they might not do it, when does it make sense, et cetera. And part of that is sort of sharing experiences with people who have done it and are at various stages of execution, right? Some super seasoned, doing it forever, some, pretty new on their first or second fund, right? I know you guys sound like you're on your second fund now, right? So
Yep.
when you decided you thought it wanted to go set up a fund, what did you do to do homework or research on that? Where did you go? Who'd you talk to? Not by name necessarily, but just like generally, how did you approach that problem?
Yeah, setting up a fund is not easy to begin with, and there's not a lot of great information out there. So I wouldn't want to mislead anyone on that. So it was a lot of Googling. It was talking to more attorneys than I'd like to, ever do again in my life, and really understanding who understood what we were doing. You were also vetting for, did they understand what they were doing without you understanding what you knew you were doing at the same time. And even within the world of funds, there's different ways to set it up. What kind of fund? Closed-ended, open-ended. What are the terms of the fund? How do you define risk and everything that goes in your PPM? And I think most lawyers and legal attorneys in this space expect sponsors to have every answer because they're kind of the doers. And we learned a lot. We've done a fair share of what's called a sticker supplement, because you learn 6 months later, you're like, that needed to be in there, or this needs to happen, or this happened, right? And you definitely get better at it over time, but it's one of those things that you kind of just jump into at times. And there wasn't a lot of great options. And I know you guys with Verivest have a fantastic all-in-one option that really simplifies that process quite a bit.
Yeah, and to be clear to everybody out there, right? You didn't use us. We didn't know you. You didn't know us. Like, we met, after you guys had gotten started, and that happens a lot for us, right? It's like people that have already done it. But I would say a lot of what you're describing is, having done this for, I've run 12 funds and for 25 years, and the last 10 years or so, we've been doing a lot of this type of work. What you're saying is super consistent with what I hear again and again and again and again, right? The manager is looking for answers from the lawyer. The lawyer expects the managers to have the answer. And oftentimes, they don't view it in the same light. How did you kind of push through that and get to the finish line? Because I've seen a lot of people get stuck in that process and never, spend a lot of money and time and never actually, launch.
Yeah, I think for us, we took a playbook out of other sponsors we knew, like, and trusted at the time, as a starting point. We're like, if they were doing it this way, then we should be able to do it this way as well. And we started by using the same lawyers they used, the same structures that they use, and defined it within our own asset class, right? Because sometimes What's the saying go? Imitation is a form of flattery, right? In many ways, because there is no great template for this, right? That's easily accessible. So we talked to sponsors. We were LPs in our own deals or in other people's deals. So we generally had an understanding of what should be there, right? What experience did we go through, and what experience would we want our prospective investors to go through, and how simple and easy. And no one wants to read a 95-page PPM, but it's important that they do, right? And all these types of things. So how do we create and craft that experience and learn what to put in there and what not to put in there, and how to word it and what to focus on and what not to? We looked at other PPMs. We talked to a bunch of attorneys. We talked to investors, and we got better over time.
Yeah, and I think that one of the things that we find is that not all structures are created equal. Not all structures are appropriate for every asset type. There's differences depending on what type of assets you're buying, how you finance them, what the velocity of those things are, who your investor base is. All of that can inform what that structure looks like. And in your guys' case, right, this is more like hospitality almost than other types of commercial real estate, right? What nuances do you guys have in terms of your operations, given the fact that you're leasing these properties or renting them really on a nightly basis?
Yeah, I think one of the cool things about what we do is we rely heavily on an existing platform, that being Airbnb and VRBO, that handles a lot of that infrastructure for us. So when you think about like our PPM and our operating model and our operating structure, it very much looks and reads very much like you're investing in any company, right? Just like you are in any other real estate vehicle. And a lot of that infrastructure of leasing and insurance and all those coverages that you would typically expect in, say, a typical leasing agreement actually happens within the Airbnb platform itself. So it's kind of done for you, or VRBO or some of these other ones. But other than that, our PPM very much reads like any other standard real estate type vehicle, with nuances towards our operating model or nuances towards our risks, right? So like our risk section looks a lot different than, say, multifamily, right? Because we rent on a short-term basis, or like when the pandemic happened and you couldn't go outside depending on where you were, right? That would have a detrimental effect towards short-term rentals, right? So we actually call that out as a risk if that was to happen again. And perhaps a multifamily investor or a multifamily operator may not call that out because someone would still be confined to their house or to their apartment.
So what do you view as your primary risks in this fund, or the things that you consider to be the biggest challenges given this specific strategy?
I think our biggest challenge is simply execution risk, and that's why we focused a big effort on having the best talent to solve problems as they come up. When we first started, we had, we thought we would just outsource everything from management to renovation to everything. And what we learned is the type of level and bar that we look for and the type of performance we command wasn't being done by the available parties in the space, the available options. So we were forced to build it. And if you had a team that didn't have the knowledge, experience, or capabilities to do that, that's execution risk, right? Everything could have gone to shit very quickly, or at least underperformed quite heavily. And so when you're investing in any syndication, I think a big part of it is, can the sponsor execute? Can they navigate? I think this is equally most important in times where there's economic uncertainty, because that's really when shit hits the fan, right? When everything's going well, it looks great, but what happens when things don't?
And how do you guys manage that across? Like, what's your geographic territory? Are you guys all over the place? Do you have certain markets that you're focusing on, or what?
Yeah, about 80 to 85% of our markets or business happen in 3 states. So that's going to be in Arizona, Pennsylvania, and Florida, where we have really, really deep infrastructure. And then our other 15% of our business, we pull resources from those existing markets until those newer markets become and have levels of economies of scale where they can self-sustain their own infrastructure, right? So typically, like for example, in Florida, another market of ours is like the Blue Ridge Mountains of Georgia, which is only a few hours away. We can easily pull resources, go complete a project, and do that. And if Blue Ridge was to ever become one of our main markets, then we build a sustainable infrastructure as we continue to scale there.
And how big do you expect to get the fund, or what's kind of your target of size for for scale on the fund?
Yeah, our first fund was about 37 million, and I think that was more than we expected it to be. So that was a great surprise. This second fund we expect to realistically be in that 50 to 100 million dollar range, but we've built our PPM because we've gone through this before. Speaking on that, to allow for up to 150 million, right, without having to do edits and things along those lines. And it's an up to amount, not a fixed amount. And the way our fund runs is whether we raise 10 million or 50 million, there's no additional changes to how we would operate, right? So we can take in as much capital as reasonably needed.
You guys buy them on all cash, or are you putting debt on the individual properties, or what?
Definitely putting debt. Sometimes we'll obviously buy cash and do a refi, but we are always using leverage appropriately. So we're driving about a 3x DSCR across our portfolio. So we feel very comfortable with the levels of risk that we're taking.
And what kind of debt are you able to get on something where the fund is a borrower, right? Are these banks? Are they, because right there, you guys aren't taking recourse on the debt on each deal, are you?
Sometimes. So some of our debt is recourse, some of our debt is non-recourse. A DSCR product is typically, described as a business purpose type loan, right? So it is personally guaranteed oftentimes by one of us, typically one of the general partners. And that's another benefit of investing in syndication, as I'm sure you know. The general partner kind of takes on most of that risk. But we're getting, 70 to 80 LTV. We have an exclusive relationship with our lender where they're actually underwriting these properties as short-term rentals because of our institutional track record that we've had in the past. So they can see that we're driving really great performance and getting some favorable rates compared to other commercial type debt.
And then what's kind of the exit strategy, or is there one for the fund? I mean, how do you get out of it? What's the end game?
So all things being equal and all things going well, it's about a projected 5-year hold. We're aggregating these single families and stabilizing them as short-term rentals. And since selling the portfolio based on revenue, or as many people know, is based on some sort of cap rate or multiple of revenue, to an institutional buyer or to other real estate property management companies, et cetera, we believe there will be a buyer, and we've seen significant institutional interest in that space, especially at scale. No one wants one, but they want 1,000. Right? They want to be able to enter and write that large check and own that kind of infrastructure. Separately, if for whatever reason that doesn't work, we can always counter back and sell these single family homes exactly as they've normally traded, as single family homes based on their value, based on nominal appreciation that we underwrite for, and eventually exit for a lower than expected IRR, but certainly a respectable IRR given the circumstances.
You guys have any concerns over restrictions on usage in various municipalities and so forth? I know there's I was in Northern California last week with spring break visiting family and riding my bike around and seeing signs saying, these are homes, not rentals, right? Yeah. Is what any concerns over that?
We definitely get our share of opinions thrown at us for sure around what we do. But everything we do is within the law and the municipalities that we operate in. And we typically invest in one of two types of markets where regulation already exists, which we actually prefer. We're actually pro-regulation across the board and pro-legislation. Or we invest it where the market is hyper-dependent on the type of owner in that. Think a destination like Palm Springs, right, is one that actually is regulated, but you can still continue to do it. Another one for us is places like the Poconos in Pennsylvania, where $3 billion of revenue supports that infrastructure through short-term rentals. Schools, roads, infrastructure, everything there happens through the short-term rental industry. So it's highly unlikely for it to ever go away. In markets like Scottsdale, Arizona, it's by right. It was passed as a state bill, right, that you can actually operate short-term rentals unless you're in an HOA. So we just don't invest in HOAs. So there are markets, and usually where you see this mass media, and I'm happy you brought up Northern California, is usually in dense city centers, where it usually doesn't make a lot of sense to buy anyway. For example, I would love to own in the heart of Manhattan, in the heart of New York, but it doesn't make sense to buy from a real estate perspective, just the revenue you're going to drive, number one. And the city doesn't want that, right? Because that's a dense populated area. Same thing with Los Angeles, San Francisco, city of Miami, right? In those types of things. But surrounding those areas or drivable destinations are all fair game and are actually typically welcomed. And that's the part of the media that most people don't talk about.
Yeah, so far so good. How where you at in Fund 2? Or you say you're going to be targeting 50 to 100, maybe up to 150? How you guys coming along so far in Fund 2?
Yeah, I think we're right about 10 in that range. So we just started in February, and we're right now raising our second round of the year. So we typically raise every 60 days or so. So we'll land right about 10, I believe, once this round wraps up. So that'll put us on track. Last year, we raised about 70 or 80% of our money in Q4. So we expect a lot of that to kind of continue as people kind of go through the year. Summer, and like you get into the end of the year, you're like, where do I put my money? We typically see that. I'm sure you see that all the time. And those end of year investments typically pick up quite a bit. So
how are the current market conditions, which everybody knows are challenging, right? With interest rate increases and inflation and everything else, the Fed and bank failures and everything else. How's the capital raising environment going from your perspective?
I would say it's definitely one of the harder years on record. And I think anyone who doesn't admit to that is probably lying, right? Naturally, people are fearful. People are fearful of interest rates. A lot of deals don't make sense in traditional commercial real estate with where the cost of debt is and where buyers and sellers are, right, in terms of their opinions. For us specifically, we continue to be optimistic. And I think our investors are optimistic as well, because we have one of the highest yields in real estate, right? So we can stomach a lot higher of these interest rates, but also we've been performing really well, right? We drive 71% more revenue. We're about to pass $1 million in distributions this month to investors, which is a big milestone for any operator. And we've continued to, meet our numbers. So I think those are the types of operators that investors are looking for today. And I think we're optimistic that we'll continue to do well.
All right, man. Well, hey, we're running a little bit out of time, so kind of wrap up with some questions I asked just about everybody here. But what do you do for learning? Like, give us a light bulb book, audio book, podcast, quote, something that's inspired you here recently.
Yeah, one of my favorite podcasts is by Nathan Latka. I'm blanking on the name for some reason, but he is a software CEO who does these 15-minute, run and gun interviews with company leaders, and you learn so much in 15 minutes that your brain is rushing through. It helps me think about my business in completely different ways.
Now, what's the name again?
I think it's called SaaStr or something else, but it's by Nathan Latka. I'm blanking on his podcast name, but it's by Nathan Latka.
Nathan Latka. I'll have to check that one out.
Yeah.
What do you got coming up for people to look forward to? Anything cool you're working on? I mean, obviously the fund and doing all this, but anything else you got?
We just released our third version of our software. So while it is for internal use, our investors will get a look at it, which really is starting to allow us to really dive into data and become a first level owner of our own data and better understand it. So we're really excited about where that's going.
Cool. What's the best way for people to get a hold of you? If they want to reach out to learn more about you, your fund, or whatever, what's the best way for them to reach out?
Yeah, LinkedIn's a great place. Techfester.com is our website. You can always request an invite and meet with someone on our team, see if it's a good fit for you. And we're all about education first. So I know STRs are a newer asset class to many, and we'd be happy to lead some education there.
All right, man. Well, hey, it was great meeting you in Salt Lake, and congrats again on your victory. And appreciate you being on the show.
Yeah, thanks for having me, Matt. Looking forward to next steps.
Yeah, my pleasure. Okay, everybody, thank you very much for joining us. We'll see you back here for episode number 8 next week. And in the meantime, stay sharp.